Welcome, curious minds. Today, we're diving deep into a week that honestly truly surprised the markets.
It really did.
Especially here in North America. We saw expectations defied, some remarkable new records set. It felt like, the usual seasonal playbook, just completely thrown out the window.
Yeah, tossed aside.
And we're here to unpack exactly why. We've gathered a really fascinating stack of your sources, everything from intricate global market reports, detailed crypto pulse checks, and even, which I love, a very lively stonks culture watch.
Got to get the meme view.
Exactly.
Yeah.
It gives us such a direct pulse on retail sentiment. So our mission today is to go beyond just the headlines, sift through all this information, pull out those crucial nuggets of knowledge, and hopefully give you a crystal clear picture of what truly mattered this week. Both the obvious stuff and, maybe more importantly, those hidden currents beneath the surface.
Right.
Get ready for some genuine aha moments, because this is where it gets really interesting. It shows just how interconnected and often counterintuitive the markets can be.
Indeed. This past week offered a really compelling narrative, resilience, these unexpected rallies, and a surprisingly complex interplay of, economic data on one hand and geopolitical rumblings on the other.
Which you'd think would dampen things.
Exactly. But against conventional wisdom, it seemed to almost fuel optimism, not dampen it. What's truly fascinating here, I think, is how multiple, seemingly separate threads, cooling inflation data, strong corporate earnings, even the quirky world of internet memes, they all kind of wove together, created this singular, powerful market momentum that just defied the historical patterns for June.
Yeah.
So we'll synthesize these key movements, analyze the underlying drivers, and explore what these shifts could mean for your understanding of the broader economic landscape, and maybe for your own decisions.
Okay, let's unpack this incredible week then, starting with the big picture. We're talking markets that didn't just surge, they shattered records, North America especially. So when Friday's closing bell rang, what were the standout headlines, the ones that really captured this unexpected performance?
Well, the primary headline undoubtedly was the S&P 500. It closed at a new all-time record, 6,173.07.
Wow.
Which marked an impressive plus 3.4% weekly change.
For the week.
For the week, yeah. And not to be outdone, the Nasdaq Composite also hit a new record, 20,273.46. That was up 4.2% for the week.
Incredible numbers.
It really puts June 2025 in a league of its own. Makes it one of the strongest Junes for the S&P 500 since 1950.
Since 1950. That's remarkable, especially when you think June is usually known as what? A pretty flat month? Even slightly negative sometimes?
That's exactly right. Historically, it's pretty sleepy. The average June return for the S&P over the last couple of decades, basically zero, negligible.
So this performance truly stands out. It really does feel like the market just decided to throw out that seasonal playbook entirely. So while U.S. markets were hitting these unprecedented highs, what about our Canadian counterpart, the S&P TSX Composite? Did it manage to join the record party?
It did pretty well, yeah. The TSX finished the week at 26,692.32. That was a respectable gain, about 0.73% weekly.
Okay.
And it actually hit its own record high earlier in the week.
Oh, okay.
Before experiencing some, let's say, late Friday wobbles, partly due to some renewed trade talk, which I'm sure we'll get into.
Right.
But despite those jitters, its gain for June, Ruffler, plus 2.8%. That would mark its best June since 2019, which significantly beats its usual slightly negative June bias. So that resilience, especially given its ties to commodities and trade friction potential, is definitely noteworthy.
So what does this all mean? Why did June 2025 buck this whole mid-June pattern so dramatically? It seems like such a big deviation from the norm, almost like something fundamentally shifted in the market's drivers. What were the catalysts? What caused such an extraordinary upside surprise?
Yeah, that's the important question, isn't it? And it really comes down to a convergence, several powerful factors hitting at once. Firstly, we saw very encouraging cooling in the core PCE data. That's the fifth preferred inflation gauge, right?
Right, the one they watch closely.
Exactly. It came in at plus 2.3% year over year. And remember, core means it strips out volatile food and energy, gives a clearer picture.
Got it.
So this critical data point, it significantly firmed up bets on a Fed rate cut by September. Futures started implying roughly a 70% probability of a cut then.
70%? Wow, okay. So the prospect of cheaper money definitely fueled things.
Oh, absolutely. It injects powerful optimism into markets.
Yeah.
But that wasn't all. Secondly, we saw surprisingly strong earnings momentum from companies.
Like Nike.
Nike was the prime example, yeah. Their surprise blowout performance gave a huge boost to the whole consumer discretionary sector. It signaled, maybe, pretty robust consumer health. And then, perhaps most uniquely for June, these systematic trend-following funds, well, they poured over $60 billion into U.S. equities right into quarter end.
$60 billion.
In June. Yeah, over $60 billion. These are those large, often algorithm-driven strategies,
Yeah.
They automatically buy more when markets are going up strongly. This kind of massive surge of fresh, technically driven capital, you just don't typically see that in June. It created this self-reinforcing momentum that really amplified the rally, defied those traditional seasonal doldrums.
So it was a powerful cocktail then. You had hopes for easier money from the Fed, driven by good inflation news.
Right.
Then strong company performance beating expectations.
Yeah.
And then these huge systematic money flows providing this, technical push.
Exactly.
It really does sound like a perfect storm for an upside surprise. Multiple tailwinds aligning all at once, creating this momentum vortex that was just hard to resist. This is definitely one of those aha moments, seeing how these different pieces can suddenly click together. So, beyond the headline numbers and those powerful technical flows, what were the big macro themes driving sentiment? We heard whispers of central bank moves and, of course, some fresh tariff drama. That always keeps markets on edge.
Yeah, the overarching theme was definitely central bank divergence and the market making these increasingly aggressive, dovish bets.
Betting on cuts.
Betting heavily on cuts. As we mentioned, that U.S. core PCE cooling was significant. It directly bolstered expectations for a September Fed cut. It's that feeling, that maybe inflation is finally under control, giving the Fed room to ease up.
Okay.
Meanwhile, north of the border, the Bank of Canada held its rate at 2.75% back on June 6th. But importantly, they signaled potential cuts if trade tensions or other shocks started hurting domestic growth.
So hedging their bets a bit.
Exactly.
Yeah.
So you have the world's two largest central banks either seemingly ready to cut or signaling a strong willingness if things warrant it. That's a powerful backdrop.
And then there's the Canada-U.S. tariff situation. That definitely caused some ripples late in the week, right? It brings politics straight into the mix.
Yes, indeed. That became a late-week focal point. Briefly injected some volatility. President Trump's post on Truth Social on Friday, threatening to, quote, terminate all trade talks with Canada over their digital services tax, the DST.
Right, I saw that.
It immediately sent the USD CAD exchange rate spiking up about 0.7 cents to 137.30, before it eventually faded a bit by the close.
And this Canadian DST, remind me.
It's a 3% levy on digital ad and marketplace revenue for large companies. And critically, its FOIC payment was due June 30th.
So the timing of the threat wasn't accidental.
Seems unlikely, yeah. Right before that payment deadline. It's a very immediate point of contention.
So it's a direct response to this new tax.
Right.
How are markets reading this? Is it a real threat, something that could actually disrupt trade and hurt earnings? Or is it more, negotiating theater, a tactic to apply pressure?
Well, if you connect it to the bigger picture, many equity traders, initially at least, seem to treat it mostly as theater.
How can you tell?
Well, the S&P 500 still finished at a new record high even after that post came out. They seem to view it more as brinkmanship than an imminent full-scale trade war starting Monday morning.
Okay, so equity shrugged it off.
Largely, yes. However, the FX and rates desks, they did price in a small risk premium. You saw that in the currency move. It indicates they saw at least some non-zero chance of escalation.
Right.
The core issue behind all this is Washington's April Section 301 probe. That's a U.S. trade law giving the USTR the trade representative power to impose duties unilaterally without needing Congress.
Okay, so they have the tool if they want to use it.
Exactly. And right now, there's assessed to be about a 40% likelihood of targeted tariffs specifically on digital-heavy categories that would directly hit U.S. firms with big Canadian operations. So it's a calculated risk. The market, while maybe shrugging it off on the surface, is definitely watching closely, especially heading into a U.S. election year.
That certainly adds a layer of uncertainty, doesn't it? So given these macro shifts, the rate cut hopes, the trade tension potential, how did traditional safe havens like gold and maybe newer hedges like Bitcoin fit into all this? Did they react as you'd expect?
Yeah, it's an important question about these safe haven or hedge assets. Gold, perhaps surprisingly for some given the noise, actually saw its second straight weekly drop.
Oh, interesting. Down.
Yeah, down about 2.3% on the week. Closed Friday around 32.88 an ounce.
Why was that, do you think, with trade tensions flaring up?
Well, several factors seem to be at play. One was a significant degree of geopolitical de-risking after that Iran-Israel ceasefire was announced. That reduced the immediate scramble for traditional havens.
Okay, less immediate fear.
Right. Also, the dollar firmed up a bit, which makes gold more expensive for buyers using other currencies.
Makes sense.
And significantly, there was likely quite a bit of profit-taking. Gold had been flagged recently as one of the most crowded trades in fund manager surveys.
Meaning too many people were betting on it going up.
Exactly. Everyone on one side of the boat makes it vulnerable to sharp reversals when sentiment shifts even slightly. So short-term risk-off sentiment eased and gold pulled back.
So gold dipped as fear eased and positions unwound. What about Bitcoin? Many view it as digital gold, or at least a potent momentum play, sometimes a hedge. Did it follow gold down?
Bitcoin, interestingly, forged its own path. It actually managed a gain of about 3.5% for the week, closed around $106,000, almost $107,000.
Up, despite the broader crypto market maybe being a bit shaky.
Yeah, its resilience was notable, especially as the overall crypto market cap was slightly down, and we saw signs of profit-taking from some large holders, some whales. Its strength was largely supported by those continuous spot Bitcoin ETF inflows.
Ah, the ETFs again.
Yep, they logged something like 12 or 13 straight days of inflows, totaling around $3 billion.
Wow, $3 billion.
That sustained institutional demand provided a really powerful underlying bid, basically absorbing the selling pressure.
So the ETF structure is really changing the game there.
It seems to be. And it's worth noting, both gold and crypto would likely get a fresh look as hedge trades if that US-Canada spat did escalate beyond digital services. If it hit autos or critical minerals, investors would probably seek genuine diversification again.
Okay, interesting dynamics there. Let's broaden out. Beyond North America, how did other major global markets fare this week? Any surprising stories from overseas that caught your eye?
Absolutely. The global picture was mixed, but generally optimistic, kind of mirroring some themes we saw here. In Europe, for instance, the STOXX 600 index rose almost 1%.
What drove that?
Well, significantly, Nike's strong earnings gave a big boost to European sportswear giants like Adidas and Puma, signaled a pretty robust consumer, maybe.
Ah, the ripple effect.
Exactly. And there are also some underlying hopes, maybe whispers, of a rare earth agreement potentially de-escalating U.S.-China tensions. That eased some global supply chain worries.
Okay, what about Asia?
Japan's Nikkei 225 surged, an impressive 4.6% gain, closing above 40,000 for the first time since January.
40,000. What was behind that huge move?
Mostly driven by renewed AI chip euphoria. Investors just piled into companies seen benefiting from the AI hardware boom, especially those making the essential high bandwidth memory chips.
Right. The AI infrastructure build-out continues. Big moves there. So tech and easing tensions were themes. What about China? And the emerging markets? They often dance to their own beat.
China's Shanghai Composite actually dipped about 1% for the week, mostly on those lingering property sector concerns. Fresh price declines were reported, raising worries again.
Still a drag, huh?
Still a drag. However, the People's Bank of China, the PBOC, vowed faster, stronger easing measures. They injected liquidity, sparked a midweek bounce in developers, suggests policy support is still critical there.
Okay, policy backstop. What about India?
India's Nifty 50 had a strong 4-day winning streak, up almost 3%. Domestic funds were actively buying banks, cement, telecoms. Shows robust internal demand, maybe less exposure to global trade winds.
Interesting. Anywhere else?
Well, down under, Australia's ASX 200 was up slightly, just 0.1%. But that came after core inflation slid to 2.4% year over year.
Which means?
Which pushed rate cut odds for their July 8th Reserve Bank meeting above 90%. So strong expectation of easing coming soon in Australia.
Okay.
And quickly, in Latin America, energy names rallied. Big players like Petrobras, Exxon, Chevron scooped up offshore blocks in the Amazon basin, reinforces the commodity supercycle narrative.
So a pretty broad spread of positive sentiment across different regions, really.
Yeah, definitely underpinning the week's overall tone.
Okay, let's zoom in now. Specific sectors, maybe some of those under-the-radar names that caught our attention. What big themes were really dominating capital flows this week? And any surprising tickers on our hidden gem radar?
Well, two prominent big cap themes were definitely front and center, still dictating major flows. First, the AI megacaps, no surprise there.
Still going strong.
Still going strong. We mentioned Japan's tech complex names like Advantest, which is up what, 78% year-to-date now?
78%.
Yeah, leading the Nikkei's breakout. Advantis is a dominant tester for those crucial high-bandwidth memory chips. It just reinforces that AI hardware boom narrative. Huge investment driver.
Okay, AI is one. What's the other big theme?
Copper miners and base metals more broadly. Copper prices touched $4.80 a pound this week.
$4.80. That's a significant level.
It is, and it naturally lifted mining stocks globally. It really strengthened that narrative of a base metal supercycle.
The supercycle idea, right? Tied
directly to massive global grid build-outs, the EV rollout, broader decarbonization efforts. Dr. Copper is seen as essential for that green transition. So its price action signals really strong demand expectations.
Makes perfect sense. Powerful long-term trends. But okay, what about names flying a bit lower? Always fun to find companies before they hit the mainstream. Any specific tickers pop this week?
Absolutely. On our hidden gem watch list, we saw Imperial Metals ticker 3 on the TSX. It's a Canadian copper gold play. It's already up about 29% year to date. And recent drill results are significantly boosting its copper gold grades. Suggests a higher quality resource than maybe previously thought.
And it's still relatively small.
Yeah, market cap around 385 million Canadian. So still relatively undiscovered by the big institutions. Interesting for those looking at early stage growth in metals.
Okay, Imperial Metals. What else?
Another fascinating one on the US side is BigBear.ai, ticker BBAI.
BigBear.ai.
Yeah, it's up an incredible 316% year to date.
Whoa, what happened there?
It saw a massive surge this week. News of a substantial port biometric contract win shows strong government and enterprise adoption of its AI stuff, plus a big push into the UAE market.
And getting institutional attention.
That's what's compelling. Big names like BNP Paribas, Goldman Sachs recently disclosed fresh stakes, signals institutional interest is building in this, pure play AI firm.
Interesting. And we can't really talk hidden gems or high performance without touching on specific altcoins, can we? Crypto always has a few surprises.
Indeed. Beyond Bitcoin, several alts made significant moves, often driven by these new regulatory or institutional narratives.
Like what?
Well, Dogecoin, DOGE, saw a move up about 3.8% this week. That came after Bitwise amended its spot DOGE ETF filing.
An ETF for Dogecoin?
Well, the filing was amended, which many in the crypto world see as a key pre-approval tweak, signaling maybe a spot ETF for DOGE is closer than people thought. That lifted sentiment.
Okay, ETF hopes driving DOGE. Anything else?
And then there's Aptos, APT. It surged about 10% on a surprise ETF filing of its own, sent its price up through $12.
So more ETF filings popping up?
Exactly. Now, these aren't quite hidden like a microcap stock, maybe, but they're certainly high-performing, gaining visibility fast, attracting speculative interest and potentially broader institutional flows if these ETFs go through.
Suggests that institutionalization of crypto might be broadening beyond just Bitcoin and Ethereum.
That seems to be the narrative taking shape, yeah.
Okay, this week wasn't just about the numbers, was it? It was so much about sentiment. And for that, we turn to the vibrant, often hilarious world of market memes. Our sources even gave us that Stonks Culture Watch.
I love the Stonks Watch.
It gives such a direct, real-time pulse on retail thinking, how they're interpreting everything. So what were the top memes reflecting market sentiment this week? What do they tell us?
Well, what's fascinating is how these memes act like a sentiment heat map for retail flow, a real-time barometer of the collective mood, boiling down complex stuff into visual jokes. Number one meme. Unsurprisingly, given the record highs, stonks at 8 Pete. All-time highs. The classic 3D mannequin, the orange upward arrow, it was flooding Reddit, X, TikTok, often edited with numbers like 6,000 plus SPX or 20K Nasdaq.
Yeah.
And the captions were great. Things like, rate hikes, never heard of them. Perfectly capturing that market defiance, right? The collective shrug at potential problems.
I love that one. It really does nail that defiant optimism we felt. And I'm guessing Nike's massive surge, that plus 15% pop, that found its way into meme land too.
Oh, absolutely. Nike's pop made it the single biggest gainer in the S&P 500 for the week. Meme makers jumped right on it. Such a dramatic, recognizable event led to the meme, Swoosh goes faux, directly linking the logo with that rocket emoji for explosive movement.
Simple, effective.
Totally.
Ugh.
Creators slapped the swoosh onto rocket emojis, photoshopped it onto the stonks arrow, variations like just Nike playing on their slogan. Shows how fast big corporate news gets woven into the narrative, even with humor.
And, okay, with all the talk of potential Fed cuts, especially after that cooling PCE data, I can only imagine the return of a certain very popular money printing meme.
You are spot on. Had to happen, right? That softer core PCE data, the 70% odds of a September cut, it almost immediately revived the classic cartoon of Jerome Powell at the press conference.
Giving us
Money printer go BRRR 2.5, the meme showing the Fed chair literally printing cash, symbolizing QE or just the market's expectation of more liquidity, easier money.
Right.
What's new and interesting this time, though, new splices were showing a ticker tape reading 106K BTC 6100 SPX.
Yeah, linking crypto and stocks.
Exactly. Directly linking the bullish mood in both equity and crypto audiences under that single brrr narrative.
Yeah.
Really highlights the interconnectedness in the retail mind and that shared anticipation of a risk-on flood.
It's incredible how fast these visual narratives pop up and how well they capture complex feelings. It gives you such a unique pulse on what the collective retail mind is thinking, often with surprising optimism. So as we close out June, truly a record-setting, surprising month, what should we be looking for as we head into July? Any typical seasonal patterns? What key data points will be critical for the market's direction for you, the listener, to keep an eye on?
Well, connecting this to the bigger picture, July is historically a pretty good month for the S&P 500.
Yeah.
Top quartile, actually. Averages about a 1.4% gain.
Okay, so a positive seasonal tailwind statistically.
Statistically, yes. However, the sustainability of this current rally, it really hinges directly on two crucial things. First, those early July macro data releases.
Yep.
And second, whether central banks, the Fed, Bank of Canada, actually validate the market's very dovish bets.
Meaning, do they follow through or signal clearly they will?
Exactly. The market's pricing in a lot of good news right now. Any deviation could spark volatility.
Got it. Anything specific, timing-wise, to watch?
Yeah, for those tracking closely, keep an eye on U.S. half-day trading July 3rd and the full holiday July 4th for Independence Day. Thin liquidity, fewer buyers and sellers can really amplify moves then. Unexpected news could have an outsized impact.
Okay, holiday volatility potential. And key data points.
Several key prints early in the month. ISM manufacturing on Monday. JOLTS job openings Tuesday. The ADP payrolls preview on Wednesday.
All about the economy's health.
Right. All giving fresh insights into labor market inflation, which will in turn sway those critical Fed cut odds and overall market sentiment.
So given those seasonals and the data coming up, what are the big risks? What could potentially derail this positive vibe? And conversely, what could push us even higher, building on June's strength?
Okay, on the bullish side, one potential upside risk. Pension fund reallocations. They typically happen on the first trading day of July.
Ah, the big funds rebalancing.
Exactly. Usually brings global equity inflows. These large systematic moves by major institutions could provide a fresh injection of capital, continuing the rally, sort of a built-in tailwind for the start of the month.
Okay, that's the potential upside. What's the big downside risk?
Conversely, a prominent bearish risk would be any real escalation in that U.S.-Canada trade spat. If it moves beyond just digital services to broader stuff like autos or critical minerals, our sources suggest that could really shave off a significant chunk of GDP growth for both countries. It would signal maybe a summer of trade war volatility, likely dampening sentiment, causing defensive rotation.
So essentially, the market's current baseline is dovish central banks, contained trade tensions. That's the optimistic outlook baked in.
Pretty much, yeah.
But any deviation from that, either the Fed not sounding as dovish or trade friction widening, could cause serious ripples, could really shift this shrug-it-off narrative we saw in June. Okay, this deep dive has really shown us a market-defying patterns, driven by this powerful mix of rate cut hopes, strong earnings, those big systematic flows. The narratives, even the memes, they all point to this prevailing risk-on feeling, a collective optimism that seemed almost bulletproof this week.
Indeed. And while gold did pull back this week, its fundamental tailwinds are still there, right? Record central bank buying, ongoing tariff, and election uncertainty globally. It suggests these diffs might still be seen as viable for those with a medium-term bullish view. Technically, around $32.50 an ounce is being watched as a key support level.
So the long-term story for gold might still be intact.
Seems plausible, yeah, despite short-term swings.
And crypto. Despite some profit-taking, it showed impressive resilience, Bitcoin especially, held up by that relentless ETF demand. So the focus for July and Q3 seems to be on regulatory developments, especially whether those altcoin ETFs for DOGE, Aptos, maybe others can broaden institutional flows even further, pulling more capital into the wider digital asset world.
Exactly. That could really signal a new phase of crypto integrating into traditional finance.
Yeah.
But ultimately, what's truly fascinating here, maybe the biggest takeaway for you listening, is that continued disconnect between all the geopolitical noise and the actual market action. I mean, the S&P 500 largely shrugged off that Trump tariff threat Friday, right? Finished at a new record.
Incredible, really.
It highlights a market that seems laser-focused on the immediate prospects, easier money, strong earnings, and much less focused on what we might traditionally see as major geopolitical risks.
So what does this all mean for you, the curious learner, absorbing all this, trying to make sense of such a dynamic market? It leaves us with a really compelling, maybe even unsettling question, doesn't it? If markets are increasingly prioritizing rate cut hopes and earnings strength over geopolitical friction and trade tensions, how long can this shrug-it-off mentality actually persist? And what would it truly take to change the market's current powerful momentum? Is there a breaking point where the noise just becomes too loud to ignore? Or have we entered some new phase where fundamentals and liquidity just, well, overshadow everything else?
Something to think about.
Definitely something to think about. Thank you for joining us on this deep dive. We really hope you've gained some invaluable insights, some new perspectives for your own well-informed journey through this complex world of markets. Until next time, keep asking those big questions and keep exploring.
When the markets go wild, most people panic. But the smart ones, they tune in. From gold to AI, from fear to focus. TradeWinds Radio, your edge in the market storm.